Hey, welcome back again, everybody. This is part two on this riveting conversation that I know everybody loves to talk about taxes. But if you are a business owner, you know that taxation can make or break. And we heard a story from Lance in our first episode of when you don't take taxes into consideration, how that can really be detrimental to your business and also what you're able to pull away, right, Lance, from a business when you do walk away. And I know there's a lot of folks that say, well, you start a business to sell it, and I really think that is a really good piece of wisdom that as you're starting your business, you also put into play, because Lance, that last episode, you alluded to that when you're getting ready to value a business and know what your gains are, need to know what cost basis is. And that's somebody like you being in on the very beginning of the business so that you can keep those records on tax basis and depreciation and all of that. So welcome back to this call. We want to take this session and we want to focus a little bit on some strategies. And I know there's some folks that are philanthropic, and there's some charitable ways that you can minimize some taxes. I think that's too big of a can of worms for this episode. So let's focus on some other strategies that you and I can talk about, and you would recommend for minimizing tax burden.
Sure. So, thanks for the opportunity to kind of dig into these topics.
Yeah,
I've got a
yeah.
list of several items that I will touch on briefly. Basically, it will simply list out maybe a brief description, the options that I kind of take into consideration when someone approaches me about an analysis on selling their company, or even a portion of their company. Number one, you've got to deal with the deal structure, and that relates primarily to whether it's an asset sale or a stock sale. Are you selling just assets out of your company, like territory and goodwill and trucks and machinery, and just selling all of that out of the company and closing? Or are you doing a stock sale where someone comes in and buys the stock of your company, and basically you just sign over the stock certificates for a fee, of course, and walk away, and the buyer now owns your company that you've had. So
Sure.
Those are the two primary ways. By far, the most common of those two options is an asset sale. That's where you're just selling all the assets out. That is most advantageous for the buyer because it allows them to pay a fair market value for the assets. And, especially in the case of machinery, equipment, trucks, things of that nature, they're essentially getting those assets to their fair market value so they can be depreciated. And under the current tax legislation, there are very favorable write-offs for depreciation. And even with territory rights and other intangible assets, you're paying a certain amount for those and amortizing it over 15 years, 180 months. So you're getting actual tax deduction for that cash outlay, which is what most buyers want. Whereas if you get a stock sale, if you're buying the stock of the company and all of the assets are fully depreciated, there's no tax basis there, then they're still putting out cash for the company, but they're not getting the favorable write-offs that you would get with an asset sale. So it's less efficient from a tax standpoint for the buyer. Okay.
Sure.
Of course, with taxation, there's always a yin and a yang, and the asset sale is usually less advantageous for the seller, where I as a seller would prefer a stock sale because I'm going to get capital gains treatment. And that's why these two deal structure options are kind of they kind of contradict one another in terms of the tax benefits, and that's just the way the law is written. I, as a seller of my stock, would pay a maximum at the federal level of 23.8%, which is often far more favorable than what I would face if I sold the asset and paid up to 39+% in the top bracket at the federal level, to say nothing of a state impact. So that's where you have to, number one, establish what type of deal is it. That could be gathered from the APA or the settlement statement documents that the client brings you. That's number one. And can we change it? You know, is there a way to negotiate a different structure for this particular transaction? But once you get through that piece, especially when you're dealing with an asset sale, then you got to deal with sales price allocation. You know, what are you selling, and how are the values allocated between goodwill, territory rights, other contract rights, legacy lease agreements, vehicles, machinery and equipment. All of those allocations have tax ramifications, where I, as a seller, I'm going to want as much value as legally possible. I mean, you still got to deal with valuations that have fair market value taken into consideration, but I want as much of that value assigned to my legacy contracts or goodwill or territory rights, because when I sell those things, even as an asset sale, if I've held them longer than a year, I get capital gains treatment, which is the 23.8% federal max rate, as I mentioned. Whereas if I'm selling a truck, then I'm paying up to the top tax bracket of 39-ish%, depending on where the law ultimately lands in the period. So it's far less favorable to have too much value allocated over to the fixed assets. But think about it from the standpoint of the buyer. They're going to be on the opposite side of the table and tax spectrum. They're going to want have much value pushed into those trucks and machinery, equipment, and other depreciable items as possible. And that's where you've got to have a broker managing the process and trying to help everyone meet in the middle and get the deal done in as efficient, tax efficient manner as possible. Another item I look at is, well, two things. The Martin's ice cream case, depending on the nature of the business, you can often assign as much to personal goodwill as possible, which gets the value outside the company to the individual holder of the stock. And so in that case, it's treated as goodwill. And if that owner is in another state, you can get that value assigned to another state. And you're reducing the federal level tax, and you're potentially mitigating the state impact as well. That's a little more technical, but I've seen it work very well over my career, because most of the time with these small businesses, the goodwill really lies with the owner. Every customer interfacing with that company rely on that main owner of the company. Another option I look at, going back to the stock sale real quick, is Section 1202. If it's a C Corp and you've held the stock for more than 5 years, it's very possible that you can qualify under Section 1202 for a zero federal tax rate. So in other words, you sell the company, you sell the stock of the company and pay zero federal tax. And most states also allow for that code section. And so you avoid tax on up to $10 million at the federal and state level. There are a lot of different, I say a lot, primarily 5 different requirements to meet there, but I have those come through a couple of times a year. And certainly those are the happiest clients who can sit there and sell their company and pay zero tax at the federal or state level, or even, depending on when you started the company, maybe it's a 50% of the value of the gain gets taxed. Either way, it's far more valuable. And another way we look at it is installment sale. These are becoming far more common in recent years because of liquidity drying up at the banks. And so the seller is often having to finance the transaction themselves. What that does, as long as you're on a cash method and everything, you're selling the company, and you only recognize the gain and pay the required tax as you collect the cash. So it spreads that gain out over a series of years, which potentially
can be significant.
Potentially keeps you in a lower tax bracket from year to year. So that's another thing I Yeah, and that's just a thing that normally develops naturally because of cash flow. And it
Yeah.
actually is advantageous for the seller.
Yeah. Well, and I know, Lance, like I said, there's charitable, there's a lot of other different options, and um, what I don't want you to do is to feel like you're giving out advice that often is specific to a particular business or owner. So in the next session, because that was extremely valuable information. So on the next session, we're going to finish out this three-part series by talking a little bit about financing, and I know we alluded a little bit to that in this session, but seller financing and kind of what does that look like from a taxation issue. So Lance, again, Lance Mize with Artifact CPA Group, thanks so much, and we will see you on the next call.
Thank you.